Picture this. You're sitting on your couch in the evening, scrolling through your banking app, and you realize your savings are barely growing. Maybe you've got a few $1,000s sitting in a savings account, but the interest is so tiny it's basically invisible. At the same time, you hear on the news, groceries are getting more expensive, rents are rising, vacations cost way more than they did just a few years ago. Translation: your money is losing value. It's like an ice cream cone melting in the sun. The longer you wait, the smaller it gets. And here's the truth. Saving alone is no longer enough. If you want to protect yourself financially or even build real wealth, you need your money to work for you. Now, let's be honest. A lot of people panic as soon as they hear the words stock market. They picture chaotic charts, confusing jargon, and Wall Street traders yelling into phones. But the reality is, investing doesn't have to be complicated. You don't need to be a finance pro. You don't need to check the news every day. What you do need is a simple tool that gives you access to the power of the stock market without stress and without huge costs. And that tool is called an ETF. In this video, we're going to cover everything you need to know what an ETF actually is, why ETFs are such a powerful option for most people, which ones make sense to invest in, and how to get started. By the end, you'll not only understand the hype, you'll also feel confident about taking your first steps. So, what exactly is an ETF? The letters stand for Exchange Traded Fund. Sounds fancy, but the idea is simple. It's a basket of stocks you can buy with a single click. Think of it like this. Buying a single stock is like buying one apple. It's great if that apple is fresh and tasty, but not so great if it turns bad. An ETF, on the other hand, is like buying the entire fruit basket. You get apples, bananas, grapes, pears, all mixed together. If one piece of fruit goes bad, it's no big deal because you've got plenty of others. That's exactly how an ETF works. Instead of betting on a single company, you automatically invest in hundreds, sometimes even thousands of companies at once. And the best part, you don't have to pick them yourself. There are three big reasons ETFs have become so popular and are almost unbeatable for most investors. First, the cost. ETFs are cheap. While actively managed funds can cost 1.5% per year, most ETFs cost less than 0.3%. That difference sounds small, but over 20 or 30 years, it means thousands of dollars more in your pocket. Second, diversification. Remember the fruit basket. With a single ETF, you can own shares in hundreds of companies from all over the world. If one company fails, it doesn't matter because the others balance it out. You're not putting all your eggs in one basket. And third, simplicity. ETFs are the ultimate set-it-and-forget-it investment. Once you've chosen your ETF and set up your investment plan, you barely need to do anything. No stock picking, no market timing, just automatic investing that runs quietly in the background. ETFs sound amazing and They are. But that doesn't mean they're the perfect fit for everyone at every stage of life. So let's break down who should invest in them. ETFs are a great fit for you if you have a long time horizon. They aren't a get-rich-quick scheme. They're a slow, steady path to building wealth. You should be ready to leave your money invested for at least 15 years, ideally longer. They're also for you if you already have an emergency fund. Before you invest, make sure you have 3 to 6 months' worth of living expenses saved in cash, somewhere safe and accessible like a savings account. That way, you won't need to sell your ETFs at the worst possible time. And finally, ETFs are perfect if you want to build retirement savings, or if you simply want to babysit your investments. If you'd rather spend your evenings with friends and family instead of reading financial reports, ETFs are designed for you. On the other hand, ETFs are probably not ideal if you need the money in just a few years for a big purchase, or if you're the type to panic when your portfolio drops in value, and, trust me, it will drop sometimes. The golden rule is simple: only invest money you can leave alone for the long term. Okay, let's get practical. How do you go from "I want to invest" to actually owning your first ETF? Here's a simple 3-step plan. Step 1. Open a brokerage account. Think of this like a digital safe where your investments are stored. Without it, you can't buy ETFs. The good news is many online brokers and banks offer free accounts. Look for one with low fees and good options for setting up monthly investment plans. Opening an account is usually quick. You can do it online in under 20 minutes with a quick ID check. Step 2. Choose your ETF. Don't overcomplicate this. A simple, globally diversified ETF like an MSCI World is a fantastic starting point. If you want a bit more exposure to faster-growing economies, you can add an emerging markets ETF when you choose. Check the TER or total expense ratio. Lower is always better. Pro tip: every ETF has a unique code called an ISIN. Use that code to make sure you're buying the exact one you want. Step 3. Set up an investment plan. This is where the magic happens. Decide on an amount you can comfortably invest each month, maybe $50, $100, or $200. Your broker will automatically pull that money from your bank account and buy ETF shares for you month after month, rain or shine. This is called dollar cost averaging, and it takes the hardest part of investing off your shoulders, deciding when to buy. Once your plan is set, you don't have to do anything. Your wealth builds itself in the background while you live your life. This brings up a classic question. If you have a lump sum of money, say $10,000, should you invest it all at once or spread it out with a monthly plan? With a lump sum, you put all your money to work immediately. Statistically, this often leads to higher returns because, over the long term, markets tend to go up. Studies show that about 2/3 of the time, investing a lump sum beats spreading it out. But it takes guts. Imagine investing your $10,000 today and tomorrow the market drops 10%. Rationally, you know it'll recover. Emotionally, that's tough to handle. A monthly plan, on the other hand, feels safer psychologically. You buy more shares when prices are low and fewer when they're high, spreading your risk. The hybrid strategy is a great compromise. Invest a portion of your lump sum now and put the rest into a monthly plan. The bottom line is, whichever method keeps you comfortable and consistent is the best one for you. So, how do ETFs stack up against other investments? A savings account is safe, but inflation eats away at your purchasing power. Real estate can be great, but it requires a huge upfront cost and a lot of work. Insurance-based pension plans often come with high fees and little flexibility. ETFs hit the sweet spot. They offer low costs, great diversification, and historically strong long-term returns. While their prices do fluctuate, for long-term growth that's accessible to almost anyone, ETFs are incredibly hard to beat. If there's one concept that feels almost magical in investing, it's compound interest. It's simple. When you earn returns, those returns themselves start earning more returns. It's like a snowball rolling downhill, getting bigger and bigger on its own. Let's say you invest $200 a month into an ETF with an average 7% annual return. Now, even the best tools can backfire if you fall into common traps. The biggest mistake is selling in a panic when the market drops. You have to stay invested and give it time to recover. Another mistake is being too narrow, like only investing in one country. Go global instead. And finally, avoid chasing the next hot trend. Stick to a broad, simple plan. Let's be real, investing can feel intimidating. But here's the truth, nobody can predict the market tomorrow, but over the last 100 years, it has always gone up in the long run. ETFs aren't a gamble. They're a simple, powerful, and proven tool, and you don't need to be rich to start. You just need to start. So here's your challenge. Open that account, choose your ETF, and start your plan, even if it's just $25 a month. Your future self will thank you for it. Thanks so much for watching. If this video helped you feel more confident about investing, please give it a thumbs up and subscribe for more content to help you build your financial future. See you next time.